Good day, everybody. Brian here from quantlabs.net. I just tripped up quantlabsnet.com. That's the new domain. Anyways, let's talk about Quora here. I put together the last 6 weeks because I went MIA, missing. I'll may do a video on my email list on what I learned from an investment standpoint. To get that information, you got to be on my email list. If you want to know and get my HFT ebook as well, go here, description in the video where to go. Anyways, very important information here, I think, when it comes to retail traders versus the like of high frequency trading people. So this is on Quora. Why? And this is probably a while back, 9 years ago, but I think the concepts are still the same. Why don't big banks create high frequency trading divisions to compete with smaller firms? Now, one of the answers really caught my attention here. So it's from this guy here. I can never say wow. I gotta be honest. I'm not an expert. But we'll just say Mr. or Mrs. Wang. Okay. Former trader at IMC Financial Markets, heading a trading team in 2008 to 12, and other people as well. So I think this guy knows what he or she's talking about. And this is just generally put out there for those watching that are in the retail trading space versus those that are trying to learn about high frequency trading. And a lot of firms are moving this way. And on top of that, throwing on the machine learning, the AI changes everything, as you can imagine. Anyways, let's talk about what this person has to say. Let's first talk about zero sum games. Claim that stock market is a zero sum game is a very controversial one. I'm not going to get into this debate, neither am I. But I want to take a leap of faith to believe that at the same time horizon as HFT, on the order book of seconds or minutes, the market is very close to being a zero sum game. If somebody makes money, somebody else will lose money. And we know where that goes. So, this time horizon, who are the winners and losers? High frequency tradings are, as a whole, of course, are the winners. Ask Ken Griffin, who founded Citadel. He's grown and he's one of the wealthiest people on the planet because of it. Who are losers? Retail traders and investors as a whole are definitely losers at any time horizon. Okay, so if you're not willing to put the time into going down this road of learning quant, high frequency trading, you're already at a disadvantage. Like it or not, if it's within the US, there's going to be the international competitors able to trade in the US markets. And that's what always needs to be remembered. I'll probably go into another answer on how that was covered from the banking side. Non-HFT institutional traders and investors such as banks, hedge funds, as a whole are losers, but they may turn out to be winners when looking at longer time horizons. In other words, they're not able to predict what will happen in 1 minute, but may be able to predict what will happen in 1 year. And that's true. But then on the other hand, why are some of the banks having bank runs? Because, well, leverage and all that. Note that I use as a whole in all three categories of market participants, since there are always individual expectations. Let's focus on the high frequency traders compete with each other. Okay, if you're small person, uh, say a basement quant, as one of the leading quants refer to, you're kind of still a small trader, but you can still get the same level of data and be able to be intellectually smart, see where the markets are going instead of just looking at a bunch of charts and using technical analysis. Okay, so the area that is made mostly in a variety of areas, market making, liquidity takers, or if you really want to get wealthy, be the person writing the options, okay, and being really good at it. You can build, you could explode your wealth in no time or blow up your wealth in a very short period of time. Okay, so very well explained. Market making or liquidity providing is one of the most prevalent types of HFT and one of the least controversial types of HFT when it comes to creation of social value. Market makers' worst enemies are informed liquidity takers who operate in a similar time horizon and who are very good at predicting the future. If a market maker trades against an informed, high frequency liquid taker, he will usually see his trade go against them over time. Let me give you an example. Right now, the best bid is $9 and best offer is $10. Some market makers to bid at $9. Some liquidity taker predicts that 2 minutes from now, the markets will trade at $7 and decides to hit the $9 bid. At this time, the trade market maker's instantaneous profit is half the spread, or 5 cents. But 1 minute later, the market turns out to be $8, and 2 minutes later, the market trades at $7. So you can see why sub-second, sub-minute's really critical here. Market maker has not been able to get out of his long position at an acceptable price due to whatever reason, is now forced to lose about $2 by selling at $7. Remember, they started at $9. This, of course, is an oversimplified example, but what is observed by market makers all day long. If the market makers lose to liquidity takers, how do they make money? Well, they make money off of non-HFT and institutional traders who are not able to make good predictions at the time horizon that they operate at. Okay, this is really important because this is why, as you said, the banks, the hedge funds, and retail traders using their trading view, whatever, lose money. However, as passive liquidity providers, they wait for others to hit them, like waiting for fish in a river. They explicitly choose who to trade against. And it gets more daunting here. They do develop strategies to maximize the likelihood of trading against uninformed traders, also known as dumb money, and conversely minimize the likelihood of trading against informed traders. More on this later. You can see why I'm making a video out of this because it's important to know. Okay, so um, consider four liquidity traders. A and B predict 1 minute, C and D predict 10 minutes. Between A and B, there's a lot of competition. At this time horizon, HFT traders use more or less the same signals and go for the same trades. If you're not one of the competitive enough, you'll miss all the best trades and you only get the worst ones the others don't want. And this is the adverse section. So it's another way of saying you lose money. However, it's common misconception that speed is the only thing that matters being adversely selected. In many cases, the ability to extract multiple signals to combine them into a single trading decision is just as important. What happens more often than not in the market is that a sequence of trading signals occur within a short period of time and all indicate the same direction. As a high frequency trader, you may not be aware of some of those signals and thus react on a late signal. Some other trader is aware of the earlier signals and reacts before you. This is why it's so competitive. That's why they put up these microwave antennas to get the better data faster between, let's say, Chicago and New York, as an example. They're spending billions of dollars for that type of infrastructure. Both of you are aware of the same set of signals, but the first three signals are not strong enough for you to pull the trigger. And again, this is on sub-second level. While the other trader is able to combine the first signals in such a way he's confident enough to go for the trade. Okay, now C and D. Between C and D, not so much competition. At this time horizon, there are a plethora of trading signals, and generally you're not aware of the competitors and what they're doing. Between A and C, there's also not much competition. They'll go after a very different set of trades. The key point is the difference in prediction horizons. Even if A is a market maker who's generally lower in the food chain and trades against C, it's not necessarily bad for A. C's prediction will gradually realize itself in the next 10 minutes or so, while A aims at closing his position over the next minute, during which period C's prediction will be best partially be realized. So if you're too slow, you lose. Okay, now we get the sharks eating the sharks, or the dogs eating the dogs. Market makers versus market makers. So market makers don't trade against each other, but they all try similar strategies to maximize their trading against uninformed traders, trading against informed traders ratio, i.e., example, minimize adverse section. How do you do this? They improve predictions to avoid on the wrong side of the market. So, question is, will the machine learning and AI help here? However, generally, they don't need to be as good as liquidity takers because instantaneously they already make half the spread. They optimize exposure risk management. Generally, larger traders, which the million dollar traders, billion probably, larger traders, which lead to larger positions, tend to be worse for market makers. First reason is that larger trades are done by informed traders. Second reason is that the trade itself has significant market impact, which is against the market maker. So if you are a large bank doing large trades, as it says, you will have market impact, and that will go against you, and probably regulators won't even allow it. They compete for special access to uninformed flow. Okay, special access. That's what we're talking about. Direct market access, the data, this faster data, da 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 da. They trade on dark pools where the flow can be toxic on exchanges. This is the very dangerous part that people don't know. They are willing to pay E-Trade, Charles Schwab, Scottrade, and more recently, the likes of popular one, can't remember the name, doesn't matter, but for an amount that is less than half the spread per share in order to trade directly against retail traders who on average lose half the spread per share. That's why regulators step in and trying um, to prevent this from happening. Now, I personally think that the lobby groups of these HFT firms are so strong. That's why they're still allowed to be done in the US. And the politicians are so stupid and too old to figure out what's going on. And it will never change. I watched one congressional session with a bunch of old fossils trying to understand this stuff. And these lobbyists and actual participants, be it um, from uh, um, Citadel and the popular free commission exchanges as well, part of this because they make big money on this. And retail traders are so uninformed is the way to put it the polite way of what's really going on. Okay. So one of three answers here. Let's see what else is said. Uh, so this guy knows what he's talking about for sure. I'm not going to get into other things that he's mentioned here, but I do think this is something worth paying attention to. Now, going back to the original question, uh, there's two answers. Why do big banks create HFT trading divisions to compete with smaller firms? Again, this was asked a number of years ago, 9 years ago. So it probably has changed under new regulation. Some of them used to have such divisions, but the Dodd-Frank law ruled against proprietary trading, so the banks must sell or spin off such operations unless they think they can find a way around it. Current regulatory environment doesn't make sense to keep these operations in a regulated entity. As hinted by Mr. Williams, putting such operations outside the US could, in some cases, avoid the regulations, but would suffer a speed handicap. So there you go. That's what they do. They may trade somewhere in Europe, maybe in UK, London, let's say, where the volumes are still kind of there and focus on certain instruments and asset classes where the volumes are fairly high in London. Maybe they're not regulated. I don't know. But that's one way to get around it. The other answer is well, they do. How big banks trading divisions compete with smaller firms? Here's the question. They do. My previous employer went from 5 geeks on it to well over 30. The ironic thing was each time they had a bad run, they hired more people. Now they're just going to make the AI more sophisticated 9 years later. Finally, they purchased at 7 times earning a high frequency unit from Boston. Then they moved it to Singapore, London, mainland US, keeping it vague here. Obviously, it's trying to not mention who it is. They then we learned about latency. But on a serious note, most prices that are now quoted by a bank have a model behind them. So it's not raw data. It is just the question you ask refers to the arbitrage models, and not all models are designed to do that. Okay. So again, I'm sure there's other answers here, um, but I'm not going to get into it. But you need to be aware if you're a retail trader, if you're somebody trying to do this on your own, you really got to know the difference between, as this person says here, Mr. or Mrs. Wang explained fully what's going on in the market making and the liquidity providing realm of high speed trading, namely in HFT. So there you go. Just want to put that out there. Thanks for watching. And again, you want to learn more, go over to quantlabsnet.com, register, link is below, and you can get more information about it and how we're moving ahead, building our own standalone HFT setup to try to mimic this as close as possible, or at least learn for career purposes. Thanks for watching. Have a good day.